I think the way I usually look at this is, will my daughters be driving a car? And I think they will only be driving a car if they like to do it for fun, in the same way Jason's wife likes to ride a horse. And so I think that market is going to change pretty dramatically. Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Let's start. I'm going to try to zip through exhibits C, B, and A as quickly as I can, because we have plenty covered with the history of software and then health and care and the early pages. On oil and gas demand, which is C, there is nothing particularly new here, except that I'll probably sit down the weekend and redo the supply. I mean, clearly Saudi Arabia is going to be more than 9.8 million barrels because OPEC Plus agreed to come all the way back to the 2 million barrels that they're going up 500,000 barrels in September, and I think that'll about do it. And then Saudi Arabia has 1 million barrels a day voluntary. Now, I think the Saudis are trying to collaborate or cooperate with the U.S. and bring pressure there on Russia. And so what you do when you try to do this secondary sanction type of process that Trump is talking about is you get the people who are taking Russian oils to not take it. And he's been bearing down on India because he can. Doesn't want to bear down on China because of other negotiations going on with China. Each one of them take about 2 million barrels of Russian oil. So I have the Russian oil here at 9.5, which I think is about right. So 4 exported, was half to India and half to China. If they could get that reduced, India says nothing doing, China are quiet on it. I expect both India and China will start to phase down on the oil and look for alternatives, but I don't think that's going to hurt Russia enough, get them to agree to a in-place ceasefire in the Ukraine. So I think the other thing Trump's doing is by kind of getting the Saudis' cooperation in producing a lot of oil, is put the price of oil measured by WTI or Brent in the 50s, hoping that will persuade the Russians to go along with some kind of ceasefire in the Ukraine. Who knows whether that will work? Remember, Trump shortened the thing up to 10 days or whatnot. I think the 10 days run out Friday. Let's get Steve Witkoff, who's his negotiator, overseeing Putin today. So we watch the news over the next couple of days. The problem is, to solve that 3 or 4 million extra barrels, it's going to take 18, 24 months. And U.S. production will go down. I think U.S. production by this time next year might be 12.5. And then some of these projects in OPEC and non-OPEC, will not be started. And there's depletion all the time. So it'll get solved in 18 months, but could be kind of a 18-month period of kind of bias to the downside in oil prices. Turn to Exhibit B, the bottom of Exhibit B. Futures curve, was still holding at 70 last Thursday, but it'll be lower this Thursday. The backwardation had kind of gone out of the market. The 26 price is 65. I think the backwardation will stay out of the market. The notable thing that's happening is gas is weak now. Granted, this is a September contract. We're getting into a shoulder month, but a lot of the months before this were at $4. So what is happening in gas, you can see in the production demand, the forecast have 108. When I put these numbers in, we're still just steady as a rock at 106, but the last few weeks, the dry gas estimate has been 107.5 by flats. So we are moving up to the 108. So hopefully the market stays in this prediction of 380 this year. 380 is kind of almost in the bag because we had a lot of months over $4 and then $4 next year. Exhibit A, as you know from following politics, because of the Epstein situation, the House was sent away for an early August vacation, and now the Senate has been sent away. This is kind of disconcerting because we have to get the 12 expenditure bills through by the beginning of the fiscal year, next fiscal year, October 1, or you have to go to a continuing resolution. Some of the bills, I think all the bills are passed through the House. I think some of the bills, maybe half of them or half the money has been passed through the Senate. But now the Senate is out until, probably don't come back till after Labor Day. Then they don't have too many days. The problem with getting continuing resolution, which has been what Congress is supposed to do, these 12 extension bills. I haven't done the 12 extension bills in a couple of decades. They look like they might make it this year, although the Senate bills, of course, because you need 60 votes for much higher expenditure levels than the House bills. When they come back, if they don't have time to do all that, they could always extend. They could have a short-term continuing resolution to give themselves another month to work on it. But the Senate passed all the bills that the House has passed, then they have to go to conference. So it's going to take a while, and it could be pretty messy because theoretically, if the Democrats feel like they can gain some advantage by trying to not have the government able to pay their bills after October 1, they may do that. This kind of activity is back and forth, is on balance not going to be positive for the capital markets, but it may be the way it comes out. In the meantime, a big political mystery is why in the world in May or April, or once they've been in office for a couple of months, why didn't they just release all the Epstein papers? I was talking to a friend of mine who does live in Washington and is active in politics this morning. He says it's inexplicable. Why in the world did the Trump Justice Department not just release everything? So fortunately for all of us, it's August, it's the vacation month in Washington, D.C., not Trump, but Congress. This will all bubble back up in September. And as I say, I don't think it's a positive for the capital markets. Mike, Jason, anything else?
No, I don't think so. I mean, yeah, this is the quiet time of the year, usually. So maybe we should be on edge.
Yeah, well, presidents have oftentimes taken August off, and Trump did spend 4 days in Scotland, but he got some work done there. He made a deal with Ursula and met with stormers. I don't think he's planning on taking any days off during August. He'll get back to Bedminster every weekend, hit golf balls, but I think he's going to be very active over the remaining weeks in August. We have 3 things to cover. We have healthcare, we have software history, and we have early pages. And I remember from last week, we're going to especially zone in on Tesla. Mike and Jason have healthcare news. Why don't we cover that as quickly as we can, and we'll give a more thorough coverage next week. But
sure. Well, most of the news is bad news, so I'll start with the good news. Prashad's position at the FDA for the Center of Biologics Evaluation is now being filled by their latest appointee, George Tidmarsh. So he's a industry veteran. He's from Stanford. He brings some stability back to the agency. So now he's filling the role of both head of biologics and drug evaluation. Good news out of the way. So Trump announced the import tariffs on pharmaceuticals. The high rate is 250%, which is a very high rate, but pharmaceuticals are often very high margin. So it's not maybe as bad as that sounds. This rate's going to phase in over 18 months, and he has not announced the first small tariff rate that's going to be imposed in the next couple weeks. The HHS has decided to cancel all funding into research for mRNA vaccines. I think some of that's certainly warranted. I wasn't a big fan personally of funding about $500 million into vaccine research for a bird flu that might not turn out to be a problem. And then anything COVID related, the big companies that capitalized on that during the pandemic quite literally made $100 billion selling these vaccines. I think they can fund a lot of that stuff themselves. A lot of awardees for these grants were the big pharmaceutical companies. But where it's really bad is it also pulls the plug on research that was maybe done at research institutes that were getting smaller checks, and now they're not getting any checks. We think there's a lot of future for mRNA-based vaccines, specifically if we're talking about what they're calling cancer vaccines. So it's kind of disappointing to see that research potentially dry up there. They're going to have to find new funding avenues for that. Earnings-wise, companies specifically, we had Vertex and Lantheus announce their earnings. Vertex's earnings were solid. Their new generation of CF treatments the rollout's going very well. What they did announce was that the phase 2 study for their next generation pain drug, the NaV 1.8 sodium channel blocker, was not successful. It was not more effective than Journavx, the one that they just received approval on. The bad news to that is this is the formulation they wanted to put into an IV delivery. Aside from that, Journavx, they've announced, doesn't really have a path forward for approval in sciatica pain. That specifically is a very hard indication to treat. I don't believe anything's approved specifically for that to date. So that announcement kind of takes away the best case scenario for Journavx, where they had an extremely broad label that this drug can treat pain in general across the board. So it is approved for acute pain. It's being adopted there. They're really happy with the pace of it being adopted into hospital formularies. They've gotten coverage now with 2 of the 3 PBMs. So they're really happy with how that's progressing, to the point where they're increasing sales and marketing in that part of the business earlier than they expected. But it kind of pours a little cold water on the idea that they'll run the same playbook as they did with cystic fibrosis, and they're going to continuously iterate on the first version of Journavx and produce subsequent more effective versions. I've seen some reporting that the program kind of has no direction now. I don't think that's true. They said they're going to, and they've always planned to do this, that they're going to have a combo 1.8, 1.7 blocker. So it's the two channels that your nervous system uses to transmit pain signals. So that, I don't think anyone's tested that yet, and that could be effective. So we'll see.
Yeah, I mean, I think anything that goes through clinical trials has a probabilistic outcome, and you can't, you're never going to hit 100 on all of those. So if you had been having money on the sidelines thinking about investing in something with some healthcare exposure, we think this is a high quality company, and currently the valuation is right around what we value the CF franchise at. So you get everything else for free.
And there's still a lot of everything else.
Yeah, there's a lot of everything else. I mean, there's a kidney disease franchise that's in late stage trials that could be as big as the CF franchise. So yeah, I think that one actually, sometimes when prices go down, we feel really good about it. Brings us to our next.
Yeah. So Lantheus reported pretty disappointing sales of Pylarify. Unit sales were roughly static. They had to make concessions on pricing, so revenue was down about 8% on that. The PSMA PET scan diagnostic for prostate cancer market overall is a growing market, so the fact that they did not gain share means they're losing market share. We've always viewed Novartis as their main competitive threat in the market. Turns out there's a third player with a less capable diagnostic that decided to go very aggressive on pricing. So they saw a lot of hospitals adopting, or in some cases switching to that product.
Now that product's a little different in that it has things on the label. Basically, it points out that it has a much higher probability of false positive. Normally in medicine, you end up with selecting the standard of care as the best in class. And this is a little bit of a gray area that has some potential for perverse incentives, right? So when you have a false positive, that actually incurs more billing. So maybe there's a bit of a perverse incentive here on adoption, where something that's worse as a product, it may actually be better for the customer, meaning the customer of the hospital and not the end customer. So I don't know. It's a situation to continue watching. It's certainly not ideal. But again, valuation, maybe this is a value trap. We're still wrapping our heads around it. It's now trading at single-digit multiple of cash flow.
Yes. The company still generates roughly $400 million in cash flow annually. And as long as their ability to sell the current market share doesn't diminish, they'll still generate that going forward. They have the Alzheimer's diagnostics in the future as a potential to hit the market probably in about 18 months or so. They also announced a $400 million buyback. So at this point, that's roughly 15% of the company that they may repurchase.
And they're sitting there with the cash to do it too, with no debt. So it's really a fortress balance sheet.
It is. It is. So interesting. Yeah.
Our big focus on health and life sciences is basically watching capital allocation decisions. And I think that is going to be a good case of let's see what they do. We weren't super excited about a handful of their last acquisitions over the last year or so. So we hope the management does the right thing. I guess at this point, we're just watching to see what they do.
Yeah.
And very educational for us to see what indicators to look for.
6 or 7 times free cash flow. Obviously, the best investment is your stock.
Yeah, exactly.
We have to keep moving, so we have time for Tesla at the end. Let's do software history.
Okay, I'll try to be quick. So we left off with the rise of Windows. The rise of Windows goes hand in hand with Microsoft Office, obviously, as we all know. This was probably one of the first software products that had real network effects. So if you used an Office product like Word, you created Word doc files. And then if you wanted to share those or open someone else's document, you also had to have Word. So Office file formats became the universal standard of sharing digital documents. So that was a huge step in creating value for software. Also, this time, we're talking about the 1990s. This was when Web 1.0 was beginning to take hold. A couple software standards already existed, like TCP/IP and DNS. Those are how you determine where a website lives. And that allowed internet traffic to flow. But during the 90s, we started defining a lot of software standards, like what a URL looked like, HTML, which is how you code a website, and SSL, which is the encryption layer, the security layer for transferring data across the internet. So all of these were building blocks to where the internet is today, really. And then that enabled maybe one of the most successful software applications, in my opinion, which was America Online. It took advantage of all this and made the internet a mainstream thing. So it brought it into everyone's house. The marketing was genius. They mailed a CD to every household in the United States. So everyone had a copy of the software, whether they even had a computer or not. And all they had to do was load the software and sign up for the subscription. So it was really the introduction for most people to things like email, internet browsers, and even what became text messaging. So it was internet messaging software.
Which again was network effects, right? Because everybody was using the chat on AOL. And so you see how network effects existed in pre-digital businesses, but they just work really, really well with the internet.
Yeah. And the network is global.
Yeah.
So that usage of that software product peaked, I think it was the year 2000 or 2001, at 26 million users. But AOL wasn't the only way to connect to the internet. By this time, a whole industry popped up offering dial-up internet connectivity. So those customers needed other ways to connect to have a view into the internet. That became Netscape and Microsoft's Internet Explorer and introduced what's now referred to as the browser wars. Each of those were trying to define how the internet operated, how web pages were shown and how they were transferred and communicated. And there was a lot of software tools created around that, but there was also a lot of competing standards. So you might remember back if you tried to load a page and then got a message that said you have to enable ActiveX. And then the web page didn't work without it, and some browsers couldn't do it. By the late 90s, early 2000s, that all standardized around Internet Explorer winning. The mix of the best technologies did win in this case. Notably, the one that arose out of this was JavaScript. So that's really, it's a programming language, and it's how most of the internet is still coded today. So a lot of your web pages are written in JavaScript, and what that enables over just an HTML page is interactivity. So if it's past a static web page, it's really kind of enabled the next generation of the web. It's not static pages. Now you're interacting with the web page and eventually adding content to it.
Yeah, and I think one of the things to kind of notice is what's happening with software from assembly language and then some of the more difficult programming languages like C, and then eventually you get C++, where you get object-oriented program. Each one of these steps is towards something that's a little easier to use and where the software engineer doesn't have to reinvent the wheel every time. So the standardization of the browsers and the protocols made things easier and easier and easier, which also caused things to standardize towards kind of one thing. And that's where we start getting into this winner take all in the internet with internet companies. And that's why you see this venture capital approach, power law outcomes, start to become a really popular way to take advantage of the technologies here.
Just some of the companies that arose during this time were Amazon, eBay, PayPal, Yahoo, and Google. So these are huge companies today that got their start in this early software internet era.
Okay, let's take a quick break for a message from Oakcliff Sailing.
Hi everybody, this is your weekly update from Oakcliff Sailing. We are on the water because we are in the middle of the Oakcliff International. Right now we're watching a pre-start between Dave Perry and Cole Tapper from Australia. There's people from all over the world, thus the International. You're going to be able to see Chris Poole coming in and winning his race. He had a up morning yesterday and a down afternoon, but he seems to have won both of his first two races here. We have a lot of volunteers on the race course, and also it's the International, so Dave Perry versus Australians Cole Tapper, but there are Oakcliff graduates on almost any boat. So if you're thinking about match racing, there's a few opportunities left in grade 3s coming in. And then next year, or grade 5s rather, then next year we have the World Match Racing Tour Academy, which is really an excellent way to get your talent up. This is Pinckney. They won all of their races yesterday. A young team from California. Today, they think they've had 2 losses, which is a bit of a surprise, but anything can happen in match racing. That's the exciting part. One-on-one, offense, defense. Anyway, that is your update from Oakcliff Sailing for this week. We hope to see you on the water, and follow us on Facebook.com/OakcliffSail or on Instagram and all the social medias for updates as we go.
And now back to the show.
I think we got 5 minutes left. In addition to covering the history of chips and the history of software, I'm interested in looking forward. And I've been a skeptic of Tesla's valuation. Very impressed with their balance sheet. Here we turn to page 1. Tesla is way smaller than the other 4 companies on page 1. Its free cash flow based on the March quarter is around $5 billion a year, where everyone else is. I mean, Apple's 100, Microsoft is 76. From a revenue point of view, they're also a lot smaller, 100 billion versus the peak here is Amazon at 650 because of all logistics business, but Microsoft, which is all software and services, at 300, Alphabet or Google at 300. So they're quite a lot smaller. Tesla has impressed me since we added the page. I began to look at 10Ks and 10Qs. Look at that balance sheet. There's $5 billion of debt and $36 billion of cash. And if you compare that to any other car company, General Motors, Ford, Toyota, Volkswagen, Mercedes, BMW, no one has a balance sheet like that. Plus, they're all new employees, so there's no pension liabilities. Their ability, and a lot of this I pick up from Mike and Jason, who've spent lots of time looking at Tesla, their ability to make the cars, to get the cost down, to source a very high portion of it in the U.S. For example, the batteries are a huge part. Well, they've been making batteries in a joint venture with Panasonic since they started. This is very impressive. The problem I had with Tesla is the valuation. With 3.2 billion shares outstanding at $3, that's $1 trillion per billion of free cash flow. So what I assume is, or what I, take away from that is that something like 2/3 of that valuation of $1 trillion is what can they do in the future. Now, what they could do in the future look to be expand in China, where they have a big factory, expand in the US, where they have a big lead, and expand in Europe, where they build a factory. Those things all look like they're not going to happen. I mean, they're kind of stuck at 2 million units. So the next thing would be Robo-Taxis, basically using their full self-driving program to basically be Uber, only they could do it at much lower cost because there won't be drivers or humanoid robots. Now, is it possible that those businesses are worth 2/3 of $1 trillion or 500 or 600 billion? And this isn't rehearsed. I haven't discussed this with Mike. I certainly haven't discussed this with Jason. So with that, given the fact we only have a few minutes left, we can continue with this next week. How do you think about a $500 billion or $600 billion value for those future businesses? And I would have thought impossible. But then next week, we're going to look a bit, in addition to healthcare, we're going to look a bit at Uber, and DoorDash. Uber also delivers food and DoorDash delivers food. But I mean, are we looking at 3 years? When you get a cab, it rolls up to your door. It looks like a Model Y. You can get in behind the wheel if you want to, but you don't have to. If it's Uber Eats or DoorDash, you have a humanoid robot popping out to deliver food. I mean, what do we have to think, and how quickly does it have to happen, and how capital intensive will it be, have it be worth, $500 billion now? Mike and I talk at 20 minutes every morning, so even though Jason had the mic for most of the time, I'm going to direct that question to Jason. How do you think that through?
Well, in my mind, the future will be transportation as a service, and a autonomous vehicle will pull up, pick me up, and take me somewhere. I think that's almost a guarantee. It's who does it, and does Tesla do it and own that market? That's still a question. If that were the case, transportation is such a huge part of our economy that it could make sense that it's worth $600 billion. Today, with all the uncertainties, it's really hard to say that it is. That's an expensive lottery ticket.
You look at Uber's valuations, $180 billion. So you could say, oh, okay, well, maybe it could be worth that much. But the bull case is that the cost for them to serve a mile versus Uber's is significantly lower. Tesla keeps throwing out there is about 25 cents per mile. And currently you pay closer to $2, sometimes more per mile. So this is another one of those things where if you get the cost down, the volumes go up so high.
And the federal reimbursement is, I believe, 81 cents a mile.
I think the way I usually look at this is, will my daughters be driving a car? And I think they will only be driving a car if they like to do it for fun, in the same way Jason's wife likes to ride a horse. And so I think that market is going to change pretty dramatically.
Right. Jason, the car, we only got a couple minutes left, and we'll continue this next week because it is easily the most interesting thing, I think, in the first 2 or 3 pages of our 20 pages of companies. What will the vehicle that you envision pulling up look like a Model Y? So it'll have a steering wheel so that if theoretically you want to drive it, you can. What does the vehicle that pulls up look like?
Yeah, near term, I think that is the case.
I think it's more regulatory, right? Once regulatory okays the no steering wheel, then
I think the form factor of a car changes pretty dramatically, especially for delivery type vehicles. You have to take into account that humans get car sick, especially if they're facing the wrong way. We're prone to it when it's an EV because it's less sound input and smoother, and your body doesn't know you're moving.
Oh, interesting. I didn't know that.
Mm-hmm.
Yeah. Just so we can set the stage for continuing this discussion next week, I think I'm looking for guidance from Mike or Jason, but I think there are about 250 or 300,000 Uber drivers out there now. Is that about right?
That sticks into my head as the ballpark, yeah.
It doesn't seem to me, given their success in setting up these production lines, that it would be that hard to do a purpose-built Model Y to do this in Texas. I mean, presumably they set up another production line. They're going to do it in Texas. They were rumored to be thinking about doing it in Mexico, but presumably the tariffs are going to do it in Texas. When they set up their production lines, first of all, they do it very quickly, but I mean, they should go from starting a line to 200,000 or 300,000 vehicles pretty quickly. So if this thing really caught on, as Mike was saying earlier, network effect like happened on the internet. I mean, they could literally flood our environment with robo-taxis. And then the question becomes, how do you finance this? And Jason, Mike, and I have talked about it. It seems to me that what would happen is Tesla would put up some amount of money of their $35 billion of cash, maybe $1 billion of cash, and then offer it out to the venture community to put up the equity to support purchasing these cars so that they protect their balance sheet, so that they don't all of a sudden take out a lot of debt building a fleet of 200,000 or 300,000. It would be done in a separate vehicle that would eventually probably trade publicly. So they still protect their balance sheet. And in addition to selling 2 million units, which I think is about maybe 600,000 or 700,000 in China and maybe an equivalent amount here and then somewhat less in Europe, all of a sudden they'd have a market for 200,000 or 300,000 or 400,000 additional vehicles. Presumably they'll still have a good margin in them because of Tesla's prowess at making this stuff. Look at OpenAI. It's still hemorrhaging cash flow. And when they do venture rounds in OpenAI, they do it at levels, I believe they do it at levels over 500 billion. Would you rather have equity in OpenAI, or would you rather, given this potential for robo-taxis and humanoid deliveries between the two, I think I'd take Tesla at 300.
No, I think you're right, because I think one is almost a bird. The technology risk has been diminished substantially. With OpenAI, you have technology, but you don't have a business model yet. So that part of it needs to be de-risked. There's plenty of great technology that's been invented and has not generated profits, long-term profits. If you look at the business approach of Tesla in each of these areas that they're entering, there's no reason they should not be the primary value capture mechanism for each of those new business.
Yeah. Well, we're 6 minutes over. We get caught up with our own enthusiasm here for software history. We'll be here 7 days from now, and we'll have more on Tesla. Take care, everyone. Be well and stay healthy. Bye-bye.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.